This recording will be shared and will be available on our platforms and probably on YouTube, I think, as long as that's okay with everybody. So today we want to talk about corporate venture capital, why this matters, and how we can do it better. I think, Rick, based on what I've been discussing with you, do it much better. And the objective here is to share some perspectives and experience to help you conceive, formulate, and implement your own approaches to corporate venture capital far more successfully than some people are doing today, and also give you a sense of what we do, who we are, and maybe you want to consider collaborating with us in some shape or form, which we would love, and we have many different ways to do that. So starting from there, Rick, what's going on in corporate venture capital, and am I crazy to say now is a great time to start a fund?
First off, it's always a great time to start a fund. Now, whether you're successful at it or not remains to be seen. Timing is really good. I mean, corporate venture capital is, in terms of new funds coming on board and the amount of activity going on with funds, it's at an all-time high. Corporate venture capital itself has really gone through a series of transitions. Originally, people were taking a look, corporations were taking a look at the untapped potential value of investing in early stage startups in their field, maybe collaborating with them, maybe doing some acquisitions, but there was all this news about these huge outcomes, these huge exits. And so in many cases, corporate executives saw this as potentially untapped areas where they could bolster their bottom line. One of the issues with corporate venture capital in general is there's this inability in many cases to set clear direction. There's been the idea of, well, investing in startups is a way that we can go ahead and tap into early value, help it grow, and then maybe see an exit overall. So largely driven by financial concerns. Fine. The other end of the spectrum is, well, corporate venture capital is a way in which we can invest in startups as a scouting activity. We can get involved with early stage startups, get to know them a little bit better, maybe tap into their technology, do some proof of concepts, get them on board, take a look at them as potential acquisition targets, totally from the strategic standpoint. So there's been this dichotomy of outcomes, financial and strategic, that often is never quite well resolved. And that uncertainty results in a lot of corporate venture capitalists not necessarily meeting their maximum potential, and in many cases, not doing very well at all.
Yeah, do you have any numbers on that? I mean, how are CVC doing? And in particular, I'm curious, if I take CVC and I compare it to VC, so let's just delete the C, what happens?
Okay, well, let's start with VC and success ratings. The numbers change as a function of time, and they do vary as a function of the economy overall. But in general, if you take a look at the last 20 years or so, typical venture capital funds that have been formed, roughly 2/3 of them don't meet the bar of generating returns equivalent to Fortune 500, S&P 500 returns. Okay. So what you're seeing is a lot of investment taking place, not necessarily having successful exits, or those exits that are happening are below in aggregate what's needed to go ahead and make returns equivalent to what you would do just by putting money into a mutual fund.
Yeah. And now, if I'm a company and I say I would get a better return by simply investing in the S&P 500, does this suggest then that companies are going the wrong way and even thinking about CVC? Or is there a way that an exemplary firm can do better? What are the best practice people doing today, or the people that are making returns with this?
Yeah, let me just finish that thought too on venture capital and why they haven't necessarily made that bar, and then we can translate it over to success metrics for CVC. So venture capital in and of itself doesn't follow a Gaussian distribution, right? Where you have a few people that do well, and there's the vast majority in the middle, a few people that don't do well. It follows something called the power law, which is almost all the returns are generated by very, very few exits. And venture capital in general is a hits-based business. It's like the movie business or the music business, where most of the money is made by just a few hits, and then the vast majority doesn't necessarily do as well as they could. So if you are in corporate venture capital, you may not get the same deal flow. You may not see the same benefits. You may not be able to take benefit of this power law where there's a few very large exits and off you go. So financially, it's very difficult to try to achieve those metrics where you're doing better than S&P 500. That's not to say that several of them don't, that they do have inside information. They can get into some of the good deals. They can establish relationships with some of the stronger syndicate VCs who would allow corporates in. So there is the potential for a larger financial return, but by financial return only, it's difficult. It's difficult at best.
Yeah. Now, this brings, because you and I, we've had so many interesting discussions about this. I tend to look at this starting from the corporate strategy point of view. And I, what I'm saying, and all my colleagues are saying, is companies need to transform. If a company stands still today, then tomorrow it will have a big risk of obsolescence, or in the very least have a tough competitor. And this transformation, of course, implies that we have to get better at doing new things. And one of those new things is corporate venture, corporate venturing, corporate venture capital. Tell me what your thoughts are on this, or how you tend to look at it.
I think corporate venture capital is a great portion of a company's innovation pipeline. So we were talking earlier about financial returns. Well, strategic returns, which are difficult to measure specifically the contribution of CVC. But if a company has a strong innovation pipeline or a strong vision of where they want to go, if there are practitioners of open innovation, where you don't necessarily always generate your new innovations internally, you look to the external world. How do you go ahead and find great startups? How do you collaborate with great startups? And how do you bring the innovations that they're coming up with into corporation overall? CVC is a great tool to do just that.
Can you give me some examples in how people have been successful in linking their strategy to execute on CVC? And I'll just give you an example. I talked to 3 different CVCs last week, and all of them had more or less the same message, which is, you know what, here we go. We're on our 3rd CEO. Here, the 4th new board member wants to review what we're doing in CVC, or one which was a large family group where they said, we don't even have a CVC. And so it becomes this kind of, how would I put it? This is going to be this open innovation that saves the day, but I'm not sure it really is. So do you have some examples that we can look at?
So consistent long-term innovation strategy is key to long-term corporate success. If you do have a corporation that's transitioning between CEOs and one per year, one for every other year, that's a corporation that's lost its way and is trying to find consistency in a message and strategy overall. Innovation itself can't be necessary. You can't turn a company around. You can try turn a company around in the very short term, in a year or something like that. It does take a more of a long-term vision. And this is a lot of the discussion of what strategy tools, the operation that you and I both work with, talks about, is you set a vision, you set a timeline of what it might take, where are you now, what actions are you going to take, and what does the future state potentially look like. And if you've set up a proper strategy, then corporate venture capital can be a strong assistant in implementing that long-term strategy, strategy shift. The long-term strategy shift would be things like identifying, first off, setting the fields in which you want to go ahead and use outside resources to go ahead and implement brand new projects, technologies, overall corporate direction, and so on. using your corporate venture capital activity as a scouting post to be able to work with other venture capitalists, other corporations on deal flow, identifying things that are really interesting, and going ahead and making individual investments in companies that make sense in terms of integrating them into your company over the long term. So I can't address this whole idea of, it's not going to fix the multiple CEO over time thing, but if you, a strong CVC can be that leveling factor and can be the consistent force that goes ahead and makes that transition possible.
Yeah, I mean, if we think about it, the average tenure of a CEO now in the Fortune 500 is just over 3 years. And obviously, if we're looking at a fund, well, I guess it's not obviously, but at most funds, we're probably looking at a life that's somewhere closer to 11 or 12 years from the time we start till the time we start making returns, et cetera.
That's right.
And so we are going to have this kind of misbalance in terms of how corporate budgeting and targets are working, and then what we could really expect to generate from corporate venture capital activity.
Right. So you are correct. Corporate venture capital in general is a long-term prospect. Those that get into it in general should not be able to expect real quick turn results. You're investing in an illiquid asset. That asset, be it a seed stage, early stage company, has some product lines, is getting into the market, needs to have some value developed around it, strong strategic direction, developing sales channels, developing, defensibility in the marketplace, getting to profitability and growing all the way along the road. Traditional venture capital, the good firms recognize the fact that it does take some time to go ahead and grow that value. So you're investing in the early stage, growing value, taking months, years to go ahead and develop something to the point of an exit. From a strategic standpoint, corporate venture capital should take the same perspective. Should really think about any integration with outside firms is going to take some time. A typical corporate venture pipeline may be identification of a company that's really interesting, is developing some new technologies. They'd love to go ahead and see how that technology grows and can be integrated into the corporation in the long term. Great. Work with them, have an investment, maybe build out some proof of concepts, see how those trials go. If they go well, then you integrate the technology in, and that process in and of itself is going to take 3 to 5 years, typically. And so again, CVC is not the cure-all to the short-term ills of turning around CEOs and doing churn and overall. And that's, we started this off with what's wrong with corporate venture capital. How come you do see some failures? And this is a perfect example of one of those, is the dichotomy of timelines. The corporate need to be able to react on a quarterly basis to try to see quick fixes to improve things on the short term. And yet secondarily, some of the strategy tools and strategy itself is going to take multiple years often to go ahead and implement some sort of a turnaround or to adapt to industries. You take a look at the energy industry, all these transitions that are taking place, it's multiple years to go from fossil fuels into a clean burning energy thing. So if you're including CVC and you're including startups as part of that transition, map that along that longer term transition, and you'll do well. You'll be viewed as being successful.
Yeah, thanks, Rick. We've got a couple of really interesting questions coming in from our participants here. And David has posed a question to us. I think it's quite interesting. Who should typically be involved inside the corporate to develop relationships with startups and scale-ups?
So if you're setting up an independent CVC activity, they can act as that external scout. So often they're acting under the direction of a generalized corporate strategy. But then how do you identify that? It becomes their job. Venture capitalists in general, and CVC also, their job is multi-tiered. just raising a fund is only the very, very beginning. Setting a strategy is only the very beginning. Actually going off and identifying sources of strong deal flow, which often comes through external relationships, I'll talk about that in a second, is the first end. Generating strong deal flow, an evaluation process, an investment mechanism would be sort of the first third of what a CVC would be involved with. Your corporation, you may or may not have good access to the startup community, either within your own local geography or on a global basis. How do you generate good deal flow so that you can go ahead and take a look at what's out there? Often it comes with alliances. So you have a lot of CVCs that work closely with other local venture capital firms, each of which has their own scouting network and each of which is working on deal flow, and you try to work cooperatively and syndicate deals together. CVCs are active participation in conferences. They're active speakers. A lot of them write blogs for promotion. How do you go out and put your name out there, letting the world know that in this particular field where you're trying to develop new innovative technologies that you can go ahead and see brand new things. So scouting, identifying strong deal flow, having an investment mechanism. What criteria do you by which do you evaluate each and every opportunity? How do you approve an investment? And then what happens once somebody is invested into? That failure point number 2 would be this whole idea of how do you go ahead and make investments? So if you have this investment committee, you get corporate people involved, you get different business units having a say over who you invest in. It's often a recipe for bureaucracy and possibly disaster. So the better CVCs act relatively independently once given a charter as to what sort of technologies they should be looking at, develop a deal flow pipeline, are given autonomy, relatively speaking, to go ahead and make investments. Most CVC investments are relatively small, in the millions, up to 5 million. It's rare that you see 10 million, 20 million, 100 million in a first-time deal. Percentages are typically low, 5%, 10% ownership of a company, something like that. And so those levels are small enough where a credible CVC operation can have the autonomy to go ahead and make those investments and go ahead and do it. So I don't know if I answered the question. That was a long-winded discussion about that portion of how things work.
I think you did, and I'm going to follow on with a little more detail. So we know that people in corporations, successful leaders, they're very good at building their teams. They're very good at taking that core product and ensuring it gets into the market. They're excellent at efficiency. And now we're adding a new black box to what we're asking them to do to some degree. Because for a lot of people, VC and private equity are a kind of black box. And my question to you is there a way we can open that box up? Is there a way that we can help executives and decision makers learn more about this so that it's not a mystery that somehow happens and it's something where they can follow some concrete steps, etc.?
There are a couple of black boxes to open up. I think one is sort of the whole innovation pipeline and making sure that that's developed. That's really job one. You should be doing, as a corporate executive, the CEO, a leader, you should establish a strong set of guidelines, overall general principles about the direction the company is taking, the tools that you're going to implement to go ahead and create and drive innovation all the way through, and so on. And again, CVC is a portion of that. But your overall strategy operation, maybe you have an internal incubator and accelerator to develop internal ideas. Under what circumstances do you look outside? What sort of things are you looking for, and so on? Those elements should all be put into place and be relatively solid. One black box. The second black box would be just venture capital in general. So how do you go ahead and make investments? What is the language that's spoken of? What are the terms of those investments? What are the expected outcomes? Do you sit on boards? How do you create value? How do you drive value? Do you drive towards exits? Do you care? Those kinds of things. Also a black box.
And have you seen any new developments in how people are building successful strategy on how to execute CVC? Is there something that's different or innovative?
A few. First off, historically, a lot of the people that were doing CVC were internal promotions. So you had somebody that was a business unit manager or strategy director, something like that. And they said, well, why don't we take a look at CVC also to do that? Fine. But over time, what's happening is more and more people are being brought in from the outside with a bit more of a traditional background, either in venture capital, some form of finance, some consulting work, where they've seen how things operate on the outside. So they bring those new business practices in. So CVC at its best tends to be a combination of people that are trusted resources internally, somebody who's been on executive staff and understands exactly what's going on, combined with people from the external financial world that are able to take a look at, evaluate, and drive investments overall. So that's definitely one. The second thing that's really interesting right now is that CVC is being used as an offensive weapon in certain cases. The velocity at which investments are being made is crazy strong. So you get companies, Snowflake, Coinbase, among others, who are doing multiple investments per month. I think Coinbase is doing an investment per week. Quote me on that. That would be interesting to take a look at. But at that rate, now what are you trying to do? You're using CVC as a strong scouting mechanism and investing in almost everybody in this particular field overall, and placing your bets and being able to see what's happening across a wide industry. So it's you're asking about trends. So that's one. So traditionally, it's been a few investments per year, selectively, active management, sitting on boards and so on. But there is a slice of the marketplace that's now going much more broad, horizontal, being super active, and using this as a way to go ahead and make segment broad changes.
Yeah, thanks. I have a question that's a follow-up on this from Avier, and he writes, how can you secure CVC funds for the medium and long term?
Secure CVC funds.
Yeah.
So when a CVC is set up, it's usually typically set up with a charter, and legally, whether it's actually a separate individual fund or pulled out of the company's overall general fund is a case-by-case basis, really. And it's a function of the laws and the geographies and so on. There's cases of both, but I'd say right now, the majority, and Scott, you may know this better than I, that most funds right now are simply drawing down from the general fund overall.
Yeah, I mean, what we're seeing, there's a new study that came out from Stanford recently, and they're saying that 93% is just coming off corporate balance sheets, so to speak.
Yeah, okay. I'm surprised it's that high, but so then people are drawing off the corporate balance sheet. But what needs to happen if you do go ahead and implement a CVC, do it for the long term, budget out over multiple years, figure out what the adequate manpower would be. A single person office probably won't last over the long term, especially if you lose that individual. Set up a small team with a hierarchy, give them a charter, have some associates who are doing your scouting, have the overall partners who are making the investment decisions, have a mix of people, but budget it as appropriate. One of the other things too that's often discussed is compensation. So here you go, you have a internal CVC group. Do you compensate them like other executives? Well, they're off making investments that presumably will have some financial outcome. Do they share and carry?
Yeah.
So that's often done company by company. And I think it's about 50-50 right now CVCs that do have some carry participation. By the way, carry is short for carried interest, which is the profit that's made when an exit occurs. So if you as a CVC make an early stage investment, that company grows and either is acquired or has an IPO as an example, where do those funds go? Of course, they'll accrue to the overall balance sheet of the company, but you as the individual that maybe made that decision and maybe help drive that value creation, do you participate? In some cases, yes. So also an interesting study. In some cases, that is a disincentive to others within the corporation to participate. In some cases, it works out well. So that's something you can break open and make the decision as to how you structure your internal CVC.
Yeah, I have a question here from Jacobo that is following on this. And what he's asking is, how do you, in quotes, sell the strategy of a CVC fund to a, in quotes, traditional board of directors? So this is something I was thinking, and you and I have talked about. I'm coming along, I've got a board of directors. They might not be particularly enthused about this idea of CVC. What would you encourage them to talk about it or think about it? Why should they do this?
It's a tool. It's a tool used for strategic development and innovation. And it's optional, it's not required, but it can be a very effective tool if used properly. And so if the board is anxious about the pace of innovation within a company and looking to drive new developments overall, and believes potentially that open innovation and cooperation with startups is a good activity, then CVC is a tool that can be very effective at this. So lay out the case of what the issues are, what the potential benefit is, show some other examples that are out there in your particular industry of others that have implemented this. You don't want to be left behind. So let's go ahead and take this on as a driver. Again, though, don't rush into anything. Take a look at your circumstances, your corporate environment, corporate politics, how it would be set up, how people would be compensated. Set the mission, do your planning first, and do your homework. Maybe rely on external resources. Your attorneys, by the way, attorneys that have been involved in this and help to set up CVCs for others are a great resource and a great place to start.
That's interesting to think about how you can leverage your professional advisors, including legal, in this. And I have a follow-on question on this. It's coming in from Europe. If CVC should be part of your innovation pipeline, what should be the end game? Is this an exit, an acquisition? And when is the moment that you should really think about taking more equity or disposing of the asset?
Okay. Early on, we talked about this whole dichotomy of financial outcomes versus strategic outcomes.
Right.
So strategic outcomes, what you're trying to do is identify those companies that have interesting technologies, to work with them on proofs of concept, to integrate their capabilities. If they have key people that are leaders in the field and so on, maybe you acquire that company and bring it into the fold. Part of the innovation pipeline, talked about the first third, which was to identify your deal flow, your pipeline, your investment strategy. Mm-hmm. The middle part of it is actually, now that you brought this thing, this alien beast on board, if you will, as part of the overall family, what do you do with it and how do you integrate? So you should have an innovation team, not the CVC, but an innovation team that's responsible for identifying ways in which the brand new technology that you just acquired, and I use that term loosely, but brought in and implementing. And then the last third would be the discussion we're just having, which is, okay, now that you've gone ahead and found all the great things that you can derive from this company, what happens? Do you actually at the end of the day acquire it? Do you spin it out after you've grown value and maybe it is a potential acquisition target for somebody else? Do you drive it towards IPO and so on? So that's the financial side of it. So we worked on strategic and somewhat financial growth and your growth. And then now we're shifting over to financial mode. Yeah, sure. Now, are you going to be in charge of that as the CVC? Probably not. There's other investors that have come in, venture capitalists in particular, whose sole job is to try to create value and create an exit. So you'll often see others participate and drive that move. And congratulations, you as an investor will be able to benefit from the work of others who will be pushing that exit much harder than you probably will.
Yeah, and that brings on another question from Jean-Philippe, actually, and he writes to us, what role do CVC programs play inside large corporations besides the financial returns they generate? So he's saying, I'm all in with you, Rick. Financial part of this makes a lot of sense, but now can I replace some of my traditional corporate investments, i.e. R&D, because I'm doing this, or what happens? I mean, it's a very, very good question, because this is going to be the debate that a lot of leaders are going to have to face. I've talked about finance, I've talked about strategy. Now, what does that do to my overall organization?
Yeah. So again, principles of open innovation. Tradition, I'll play professor here. Way back in the day, you had Ford Motor Company and AT&T. They were all had huge R&D labs, would hire PhDs right out of school and start to develop their own technologies. And those walls drove everything from research to development to commercialization and all the way out. Not seen very much anymore. This day and age. Most of the time, people are practicing like some form of open innovation where you're collaborating with others outside of those pure walls of R&D. So learn those principles well, exercise them, and so on. And so if you believe in working with early stage companies as potential sources of new innovation, then CVC is just simply the vehicle to go ahead and accelerate and make that happen in a structured way. Now that you set your strategy, you're scouting, you're bringing people in, you're handing them over to sort of a development group that will go ahead and work with them again on proof of concepts and implementation of various things, and off you go. So again, that whole strategy side, you would ask about specific metrics.
Yeah.
They're indirect metrics. You can talk about the number of deals you do, not that important. You want to hope that the impact of those deals is strong. I think at the end of the day, if you can point to CVC and said that our initiatives in this field, this field, this field, this field are all as a function of those new companies that we brought on board, you're going to be deemed as being successful.
Yeah, it's a tough discussion, and it brings me up to something where I see a lot of challenge, and this is this bridge between strategy and culture, and corporate and venture capital. And I'll give you an example. I met with a company, and they said, "I love CVC. I'm all in on this, and I want to go." And I said, "Great." And then I met with the CFO, and they said, "Yeah, so here's the template we're going to use for our CVC investments. And it's going to be based on a 5-year audited IRR. And what we'll do is we'll base it on their WACC."
Great.
Yeah. Anything more you can say besides great?
It's important to have this discussion early on. And if you are being judged purely on financial terms, then don't worry as much about the whole strategic aspect. You're going to pal up to more traditional VCs. You're going to align with them and syndicate deal flow independent of the strategic benefit of what you have. And you're going to be compensated and drive financial outcomes. Great. Again, it's a little bit fuzzier on what are your strategic outcomes and strategic goals. But what I'm seeing now in terms of trends on compensation and the way that CFO is structured is, oh, well, we've got this new CVC operation. Yeah, there's an expectation, possibility of some great returns, but as a minimum, what they should do is they should pay for themselves.
Okay.
So So the exits that you generate may not be superlative, may not be power law style, may not show up on the front page of TechCrunch, but what they do is they'll generate enough cash flow, and it has to be measured over time because it is 3 to 5 years or more to go ahead and generate first exits out of these things. But eventually, the monies that you put into CVC and the exits you realize allow this operation to be self-sustaining.
Okay. And
In and of itself,
yeah,
it's taken care of, but then the strategic benefit is just layered on top of that.
some people this is resonating with because I have some comments. I love that advice. So Rick, you've got some believers in the audience already. Today, we have a very fast-paced, volatile environment. You gave the example of some of the funds that are acquiring multiple companies per month. I've read about companies that they are blowing through to LOI without even starting due diligence, or doing very, very light due diligence. Mm-hmm. In this environment, how do we make CVC work?
The topic of light due diligence is interesting. There are a number of funds that work in a very agile fashion, that their value add, if especially brand new funds that don't have a reputation, if they're able to act quickly and invest in things that they feel good about rather than going through the full due diligence. It's a relatively new, more aggressive way of doing things, particularly in Europe. We're starting to see some funds like that are developing a name just because they can do fast close. So that's what's happening in this case in CVC as well, is that they're doing that. And I'll talk about one other example, which is interesting and somewhat related, and that's accelerators. So accelerators, if you think about their financial model, those like Y Combinator and 500 Startups and Alchemist and others out there, TechCrunch, Techstars, that do these, they do light due diligence on all their startups. They play statistics. It's like showing up to Vegas and just placing bets on all the tables, and you know that eventually something will turn. So that's one model that is used in the venture capital world. Accelerators, these short fund, these small funds that are doing a lot of individual investments. You don't sit on boards, you don't actively participate, but you're relying on overall statistics. Then if something rises above the field, then you do a second and third investment, you follow them along. And actually, if you study power law economics, that's the way you grow. You make an early stage investment, you might get lucky, but then it's that second and third follow on where you may end up scoring quite well. So let's unpack that.
Yeah, please.
Okay. If you are a CVC, yeah, there's a case to be made that says you do a lot of individual, you get a lot of visibility overall. If you are in an industry that's moving very fast, why not go ahead and get participation and make friends with almost everybody that's out there in your field? It's a Coinbase strategy. That industry is moving so fast, it's not even funny. Why not? I think it's brilliant on their part. Okay, then what? Well, how many of those do you actually take on as projects? How many of those do you bring into the innovation pipeline? And how many of those do you then separately maybe drive into the financial pipeline with second and third investments and drive towards exits? That's what your team's all about. That's what they'll do on a daily basis.
Talk a little bit about mindset. Mindset in the VC world you've just described is very much about placing bets and a recognition that the majority of those bets will not pay off in any meaningful way. But by having more opportunities, you'll have the potential to hit the power law and get those really big stories so that you can say, I was the original investor in PayPal or Skype or all these other fun names that come up.
Save that PayPal example. I'll bring that up in a minute.
Okay, so PayPal example, I've got a note, a bookmark in my mind. Now, in a lot of corporate worlds, as you know, the idea is that I can really study what's going to happen, and I can develop the best product or service, et cetera, and bring it to market. And you know, if someone makes a mistake, probably on the second mistake they get fired, or at the very least they're kind of. Now, how do I marry these two worlds together? How do I change this mentality or this way of thinking?
Okay, so the internal. First off, I'm from Silicon Valley. This is a risk-taking culture.
Mm-hmm.
We're used to it. There's no such thing as failure. It's just, I always say, we just say, it didn't work out. Hey, you know, Greg just did a startup. It didn't work out. He's now on to his next or third or fourth startup. That's all good. So around here, I'm just sort of used to that attitude, which says, oh, well, things happen. And it's often not under your control. It's environmental, it's competition, it's technologies, it's something that's out of your control.
Mm-hmm.
So the mindset here is strong. I actually see the change in mindset working slowly on a global basis. This absolute dread and fear of failure as a career-ending move, that's dropping down overall. I think it's just a management style. You are seeing people that are able to take risks. Think about you as a corporation and the propensity to take risks. If it's low, if your projects are long-term, there's a lot of investment. If you fail at that project, you're going to be career limited. So on. Maybe you're not the best corporation to take on something as innovative as corporate venture capital. I don't know. Maybe there's some bigger problems to fix.
Yeah, that's a good question. PayPal. Let's come back to
PayPal. So plug and play tech ventures, often cited as, well, certainly one of the top 10, sometimes even the most active VC in the world, depending on where you look at, but they're always, top 5, top 10. It turns out that group, the family that started out, it is a family fund. Plug and Play Tech Ventures, was a set of merchants in Palo Alto running various rug stores up and down. And one of the rug stores that they had on University Avenue had some office space upstairs. That group, now known as PayPal, couldn't afford rent, but offered instead to pay a little bit of equity in compensation for that. Rug merchant said, fine, we'll go ahead and, well, they didn't say fine, they argued over it a lot, but eventually said, okay, this makes sense. We all know what happened there. It went pretty well. Oh my God, we're geniuses. We now know about investment. And so that Plug and Play Ventures was started circa, early 2000s, and is now extremely successful and makes multiple, dozens of investments per month, if not more. So it does happen. You can do that from a corporate standpoint as well. If there is an early success, something like that, then you're deemed as being brilliant, and the corporate CVC people are seen as heroes, and you get at least a period of time at which you can go ahead and do no wrong, make your investments, be more aggressive, and so on. So I think that was the purpose of the story, which is to say, this happens. That's the way things get started, is you start early on, you have some hits, and you're able to develop. And what they do now is they make a lot of investments in small industries across the board. And it's that playing the statistics that has made them successful.
I had no idea that they had been started as rug traders. That's fascinating.
There's a whole, that's a good story. And they love to tell it as well, Saeed, Amidi, and crew. So anytime you go visit or speak to any of the Plug and Play people, you'll hear more about it.
That's so cool. Just a few questions to go through relatively quickly. I think you've already answered this, but I'm going to ask it again because some people don't believe me. Today is a good time to start a fund, yes or no?
Yes.
Yeah. And you and I have spoken a little bit about co-investing versus doing the whole VC thing on your own. So I see some companies and they're saying, why don't we just team up with a existing fund and we'll co-invest with them on some of their projects where we think there's a fit. So a question to you, co-invest as opposed to becoming an LP, a limited partner, as opposed to starting your own fund. This is kind of a three worlds. What do you think?
Well, if your goal is to be a scout and to take a look at new technologies and to be able to climb aboard and participate in those, and you care less about the strict financial outcome, more strategic, any one of those options is perfectly fine. So if you have local funds that have good deal flow, or you know of funds that in your specific sector that are doing well and they are willing to partner with you, you can be an LP and invest in those and watch their operations. You see good deal flow. If you have one or two funds that you're really confident in, you can go ahead and co-invest directly along with them. So they may have a dozen deals that they do, and you see two or three that you like. You can go ahead and co-invest in that. You can sit on boards. We should talk about board seats and observer seats too when you have a chance, but you can participate in it. Or you can set up your own firm if you believe that you will have good deal flow. You can make those investment decisions. The issue with VCs is they are not driven by strategic outcomes.
Right. So
their deal flow may not be perfect for you. They're strictly motivated by financial outcomes. So if you're able to participate with them and get your strategic outcomes at the same time, wonderful. But if you have to go ahead and set up your own fund in order to achieve that, understood. But each one of those three are common practice.
So then just before we get into the governance part, which I think is really important when we talk about the boards, I want to talk a little bit about value creation. And, specifically you said VCs, they might not be interested in strategic outcomes. It would seem to me in some areas, the CVC or the corporate investor has a much stronger possible play in value creation because of their existing ecosystem, the platforms they already own or that they participate in, and their massive industry knowledge that often they could be the global leader. Yet we see the VC outperforming them. What's value creation? I don't know the exact question to ask here, but I have a very strong hypothesis on this, that the corporates should be better at value creation. You agree with me or no? This is a moment you can say, no, you're wrong.
Value creation, strategic value creation. Yeah. I mean, the corporates will be if the startup has a product line that's in production, the corporation could be a customer, if not the largest customer. They could be a distribution channel. They could be a co-developer of a new product or technology, where the corporation has stronger industry knowledge, stronger hardcore R&D capability, and the startup benefits. So both commercially on the customer side, as well as all the technology developments. Does that create value? Of course it does. For both, with any luck. Financial value creation, which is taking a company that's worth $1 million and turning them into something that's worth $100 million. 100x value creation. That's often different than different than the strategic value creation. So the 100x value creation might be just a subject of a hot market, might be the subject of doing things that are not as strategic. I'm riffing here a little bit, but you get the idea. There's a separation of the two, which is value creation for the corporate and the company, and value creation for the markets. Yeah.
Well, and that, it brings me back to that question, which we've explored together, but the link to corporate strategy or breaking away and having separate CVC strategy becomes a really important discussion, because the two might not always run perfectly in parallel. And I'll give you an example. I have seen some cases where companies make investments in excellent new technologies, but they could be concerned to exploit those to their maximum degree because of the disruption it gives them to their current business model.
Okay.
As an example.
Yeah. There could be a loose decoupling of CVC and the corporate and strategy. Some of the larger funds, the Google Fund, Intel Fund, they have a lot of autonomy. So those funds can actually make investments that they believe may, in general, be in the same area as the corporate mothership. But they're a pipeline, they're generating things, they think it's commercially interesting, so on. And then the corporation's able to take a look at those and selectively pick things that they can work on. What this does is give the venture capital firm a lot of, well, they're nimble, quick acting. They maybe see things before the corporation in general does. So this is the super large funds. This has been the trend now for quite some time. There's also a decoupling of legal obligation. And so the CVC is able to make investments in things that may be competitive over here, maybe not be, but because the decision-making process is independent, they're, you know, the antitrust people or so on can't necessarily make an argument that they're being overly aggressive.
Right. Yeah, that's a good point, especially in areas where one or two firms might have market dominance and you get into concern. Governance. We saved the best for last. So 9 minutes here to go. And we're going to touch on one of the things that I feel most strongly about, board seats and advisors. What's the difference and why do we have this distinction?
Okay. So you're a CVC. During negotiation, term sheet delivery, you have sort of three main options. One is to take a board seat. Board seat itself, you're on the board with other members. You have fiduciary responsibility. You are responsible for the benefit of all the shareholders. Next one is observer seat. You do not have fiduciary responsibility. You have visibility into the company at the board level. You can attend board meetings. You can get board minutes. You can get all the information rights that a board member would typically be subject to. Maybe with some restriction, just depends. But in general, yes. And then, you know, no formal management board seat and just simply a status as somebody that can check in, to work with them and so on. Each of them has their own benefits. And each of them has, I think those are somewhat obvious to a CVC. CVC, if you want to actually drive value creation and drive towards an exit per se, or an acquisition or acquire the company, then sitting on the board would make sense if you made that deliberate decision. Being an observer, interesting. You have a lot of visibility. You can participate in board discussions in the direction strategically of the company, but you're not obligated legally to justify those decisions. And then down here, great. So this is also it's a triangle because you can take a lot more of these on than you can here. Most capacity of most board members is between 4 and 8 boards. Right. Typically. What do you see, Scott? Is that a good number?
Yeah, unless, I mean, there are some people that have retired from other occupations that have a larger portfolio, but to manage more than 4 boards, if you also have another job or another responsibility, is very difficult for most people unless they have configured their time in some kind of unique way.
Yeah. Okay, that's consistent. That makes sense. So those are your choices overall as a CVC. Now let's take the perspective of the company.
Yeah.
Do you want a corporation sitting on your board? If you have a Coca-Cola, member of Coca-Cola sitting on your board, is Pepsi going to be involved with you or invest in you or be your customer? Maybe not. Are you going to be driven by somebody who doesn't necessarily have all of the shareholders as their primary beneficiary? They're really looking out for the benefits of their own corporation. So there's a bit of a conflict of interest going on here, potentially. Observer seat. Do you want somebody sitting in your board meetings who doesn't have fiduciary responsibility? This is even more dangerous. So here they're legally obligated to have fiduciary responsibility. Here they're not.
Yeah.
And so they can go ahead and influence everybody, pushing them in a direction that benefits the corporation, not necessarily to the benefit of the startup itself.
Yeah, I've seen that as well. That's a big challenge, actually.
Yeah, and then down here, no problem.
Yeah, to have the advisors that can work on an ad hoc basis or help in preparation for materials to the board, as opposed to voting on those materials.
Right.
For
right,
example, we've only got a few minutes left. And I'd like to make sure we do two things. One, closing thoughts. We have an audience here, I'm just checking, that includes executives, board members, entrepreneurs, angel investors, consultants, professional advisors, and people that are interested in starting a CVC or starting their own fund. What's the one thing you encourage all of them to do? It's pretty
work
wide
on strategy first.
Yeah.
Get your as a corporation, before you embark on the CVC roadmap, make sure that you have a strategy, philosophy, and pipeline built out. That CVC is only a tool. It's one of many that's available to you. It can be an effective one, but if your overall strategy planning process, those that are involved, who makes the decisions, timeline, the actual strategic plan and so on works, that's great. There's a diagram that Strategy Tools uses about the 10 steps of building the transformational company. And
do you want to pull that up for a second, Rick?
Yeah, I might have that slide. Hang on. That actually is a good one to end on here. Here it is. Cool. You can walk us through this.
I'll let you talk for a minute. I'm enjoying this, but let's just hit the high points.
All right. In the red, understanding what's going on with the industry, the ecosystem. Think about your frameworks which is core. Are you going to do core innovation, what you're doing today? You're going to look at adjacent innovation or explore beyond that. Are you going to have a transformational architecture? Is your R&D, your sales and marketing, your structure? Are you organized for proper innovation, and develop a strategy? That's important. Get that done first before you start talking about CVC. But then you take a look at here at what is that, blue or purple? Build a business model portfolio. Okay, great. Business models. Master corporate venturing, number 7 there. So this is the ability now that once you've got your act together and you're taking a look at resources and raw material to start working on, that corporate venture capital is a great way to develop a pipeline, develop strong relations with individual startups and scale-ups, to potentially bring those into the corporation, build entirely new strategic capability, invest and repeat. It's as simple as that.
Yes, well, that is a good framework. Do you have a place people can go to learn more about this, or some recommendations for all of our audience that are interested in learning more products, services, tools? They can.
Sure. Let me bring that back up again. I just killed the presentation. Hang on. Oops. Well, first off, while I'm doing that, you might want to talk a little bit about Strategy Tools as an entity.
Yeah, so Strategy Tools is based in Norway. It has a global presence with partners in more than 100 countries, and offers a number of free tools that you can download, as well as some paid programs and instruction, and offers also a platform that you can use to share, and a community, which I'm very happy to be part of personally. And that I think, Rick, I've been able to meet you and a lot of extremely smart people as a result of that community. So thank you. And the learning that takes place in Strategy Tools, I think, is very important, because we cover some of the most difficult areas that companies are facing, whether those be scale-ups or multinational corporations. So that's my 30-second introduction to Strategy Tools. We have 1 minute, Rick, left. 1 minute. What products are we going to look at today?
Okay, let me just show you that real quick. Hang on. Here we go. So let me just give, and we'll make this, I wanted to actually show this so people had it on the recording.
Great.
But here are some reports if you're interested in CVC, take a look at. So Ernst & Young, PitchBook, CB Insights, and Silicon Valley Bank. I think that for me, at least, the Silicon Valley Bank one is super interesting. All these are free and available online. I have some reading for you, Professor Rick. So these are some of my favorite books in the field. Corporate Venturing does a really good job on laying out a lot of the principles we talked about. Masters of Corporate Venture Capital is basically an example. It's a lot of case studies, so you can take a look at what others have done along the way. And then a related tool, one that's often used, we didn't talk about a little too much today, is corporate accelerators, yes or no. Historically, these have been a train wreck and mostly a mess, but there's a new philosophy coming around about how to run those more efficiently. If you're interested in venture capital in general, here's some good books. This is my favorite, The Business of Venture Capital by Ramsanjani, Mahendra Ramsanjani. Great. It's a little more expensive, but it's a strong textbook about all the details. Then I'll wrap up here. Just a couple things on strategy tools. There's a whole set of simulations that have been developed by the strategy tools team. This one is Scale Up. This looks at things from the value perspective of an entrepreneur. If you're building a startup or scale up, how actually do you do that? And teaches you cap table math, the dangers, the positives and negatives of investors, including CVC. It's a good exercise. In that tool set, there are some templates. This is Venture Capital Matchmaker. If you're a CVC and you're looking at a startup, this is a good way to sort of see whether you're going to be a good match for each other. A canvas that does the same. How do you fit together with love? It's cute. And then lastly, just fund manager. So this was a discussion between Scott and I that generated the idea for this webinar, which was this brand new tool simulation, which is coming out, which is Fund Manager. It's the simulation of how to build a fund from scratch. And there's a spin-off for family offices and CVCs and other things. But if you're interested in generally pulling together a fund, take a look at strategysims.io and you'll be able to parse down. And we do have some trials. It's a brand new entity. We do have some trials coming up, as well as a fairly large session that we're running in June.
Perfect.
So,
well, Rick, thank you. That was excellent. I would just want to thank everyone for taking the time to participate today. We do have another comment from the audience on how great to run through the 10 principles in transformation in 30 seconds or less. To all of you, thanks very much for your participation. And we look forward to seeing you soon. Rick, thanks again. And I cannot wait for the next time we get together to do this.
all right. Thank you, Scott. You're awesome.
Thank you.
And
Bye
thanks,
now.
everybody. See you soon. Happy funding.
1 second.